Brad Williams, Frugal Finance, the forward rate market, part 3. FRAs are money market instruments and are traded by both banks and corporations. The FRA market is liquid in all major currencies, also by the presence of market makers, and rates are also quoted by a number of banks and brokers. Notation and quoting of FRAs. The format in which forward rate agreements are noted is the term to settlement date and term to maturity date, both expressed in months and usually separated by the letter X. Example, 2x6, an FRA having a 2-month waiting period forward and a 4-month contract period. 6x12, an FRA having 6-month waiting period forward and a 6-month contract period. Quotation of a forward rate agreement. FRAs are quoted with the FRA rates. Thus, if an FRA 2x8 in US dollar quotes at 150 and a future borrower anticipates the 6-month US SOFR rate in 2 months being higher than 150, he should buy an FRA. Usage of a FRA. An FRA can be used for different purposes. As already mentioned above, it can be used by market participants to hedge future borrowing or lending engagements against adverse movements in interest rates by fixing an interest rate today. It can further be used for trading purposes in which a market participant wants to make profits based on his or her expectations on the future development of interest rates. Lastly, it can be used in arbitrage strategies where a market participant tries to take advantage of price differences between forward rate agreements and other interest rate instruments. The corporation learns that it will need to borrow $1 million in 6 months' time for a 6-month period. The interest rate at which it can borrow today is 6-month LIBOR plus 50 basis points. Let us further assume that the 6-month SOFR currently is at 0.89465%, but the company's treasurer thinks it might rise as high as 1.3 over the forthcoming months. The treasurer chooses to buy a 6x12 FRA in order to cover the period 6 months starting 6 months from now. He receives a quote of 0.9540 from his bank and buys the FRA for a notional of $1 million on April 8th. So we have a trade date, 4/8. We have a spot date, 4 days later, 4/12. Fixing date, which is almost 6 months forward. And then the settlement date should be 6 months. Maturity date should be 1 year forward. And the FRA rate, 0.95. Contract period, 182 days. On the fixing date, October 10th, in this case, 2022, the 6-month SOFR fixes at 1.2622, which is the settlement rate applicable for the company's FRA. As anticipated by the treasurer, the 6-month SOFR rate during the 6-month waiting period, hence the company will receive the settlement amount from the seller. The settlement amount is calculated as follows. Interest differential equals 1.2622 minus 95450 times 182 divided by 360 times $1 million. There is the exposure of change in interest rates, discounted at 1.262 to the settlement date. The settlement amount the company will receive is, we'll just look here, 15570, discounted back at 1 plus 1.2622 times 182 times 360, 1545.84. Just looking at pennies, but you get the idea here. On serious money, $1 billion, that can add up quickly. Brad Williams, Frugal Finance. Thanks for watching.